everyone. We are live now, and we are doing an awesome program. Today we are doing Chapter 18. Chapter 18 of The Intelligent Investor by Benjamin Graham, a comparison of 8 pairs of companies. Oh, I was going to check to see if I could reverse but anyway, we'll do that next time. Okay, so thank you for being on the live. Chapter 18 of The Intelligent Investor by Benjamin Graham, a comparison of 8 pairs of companies. My name is May Doldelau, and my blog is yesfinanciallyfree.com. And I just realized that I forgot to share this on my blog. So let's see if I can do that. Yes, I still can. Yay. Okay. So I did email my email list right now, and I told them they could watch this live. And usually I embed it on my blog, but I just forgot to do it. I just went live. So I'm just going to embed it really fast so that they can join in. And while I'm embedding it on my blog, I'm going to tell you guys my story and why I do these lives. My name, again, like I said, is May Doldelau. And I live in Honolulu, Hawaii with my husband, Jamel, and my 6-year-old son, Jordan. And I used to be really, really bad with money. Now, it's really interesting because back when I was really bad with money, it was around the housing crisis. And it wasn't because of the housing crisis. I was just not good with money back then. And now we have another downturn, another huge market downturn. And it's interesting to see the state of my economic affairs from back then to here. Because back when the housing crisis was happening, I didn't have any money, right? I was starting out with nothing really. I wasn't in debt yet, but I didn't have money. I wasn't good with money. So the whole housing crisis and everything, it was happening, but it wasn't affecting me because I didn't have a house and I didn't have anything that, I just didn't have those issues. So, and I didn't have assets. So I didn't have a 401k. I didn't have anything that I could lose because I was starting from zero, right? So that's one thing that's interesting to note because I've been thinking about it. And the difference between then and now for me is that now I have assets and I have things that I could lose. But the interesting thing is that I still live a lifestyle that is way more free than I did back then. So I wanted to talk about that, about my history a little bit so you can kind of understand. It changes every day because of this whole COVID-19 economic everything. So every day is a different story sometimes. But and if you watch live, I do these lives every week, every day, every weekday so far. I've been doing it this past month. Yesfinanciallyfree.com. I just posted this live there, so you can watch it live there. I am live at 8:30 a.m. Hawaii time, weekday mornings. All right, that's 12:30 p.m. Eastern time. So that's when I go live, and I'm reading this book by Benjamin Graham, The Intelligent Investor. And the reason I started reading is because during this crisis right now, I've heard a lot of people say it's a good time to pick stocks of good companies. And I realized over the past 10 years that I've been investing, I have not been the best at picking stocks. Hence, I wanted to become more intelligent, and I'm reading this book. And this is the book that Warren Buffett recommends to all people who want to be investors. He studied under Benjamin Graham, and Warren Buffett, he's a really good investor. Okay, so that's why I'm reading it. Now, the market is down. It was more down last month, but if COVID continues and they keep the economy has been effectively almost completely shut down in Hawaii. I don't know about where you live, but the effects of this are huge, right? So if they do not open up the economy, I have an Airbnb business, okay? Our Airbnb business will not be able to survive because we have no guests who are visiting and on vacation, right? And the government in Hawaii is they've actually told Airbnb that unless you have a lobby with someone downstairs working 24/7, you cannot do short-term rentals anymore, which effectively shut down our Airbnb. And we're waiting for them to reopen the economy, and they still haven't I mean, they closed it in April, they closed it in May. So there you have it. So it's a very interesting time. And so the stock market has kind of done this huge down, then it went up part way. And if this keeps going on, I don't see how it could go up. It will only go down. So the time for intelligent stock investing is now. And Ray Dalio says this is a depression, economic depression, and it's going to last for at least 3 years. So that being said, we have time to learn how to become intelligent investors. We all have the time. All right. We might not have as much money as we used to, but we have time. All right. Let me tell you my story just so you get a little background. Back in 2011, I had over $41,000 in debt. By 2016, it was gone. We bought our first condo in 2017, went on a month of vacation. I quit my job in 2016, started Finance Freedom Mastermind programs where I train people how to focus on net worth and passive income. So while you're paying off debt, you create passive income, you increase your net worth, and you become wealthier. Most importantly, you create more free time for yourself, create a better lifestyle, okay? We bought our first condo in 2017, second condo in 2018, third condo in 2019, but we sold one in the middle, so we own 2 condos. And that's kind of my story in a nutshell, all right? And I've been blogging at yesfinanciallyfree.com for years, so go there and get tons of good information about how to start your process on becoming financially free. And really, excuse me, people say that there's so many things going on, it's so much more difficult to become financially free, all this kind of stuff. It's not true, okay? I have been following the steps. Now, you don't have to know what to do. You don't have to understand math that well. You need to know how to add, subtract, multiply, and divide, okay? But other than that, you don't need to know any other math. And that you can learn, you can use a calculator if you really need help, okay? But you don't need to be a genius. You don't have to have graduated from high school. You know, you do probably need to know how to read because my blog has writing on it. But I do have a lot of videos, so you might not even have to know how to read. You can become financially free. All you have to do is follow certain steps. And one is to choose to become financially free. Now, within this time, you know, our wealth has been fluctuating. Obviously, the market declined. I'm not going to lie. A lot of our wealth did decline with the market. However, we are doing okay. We're actually fine right now. All of our needs are met. We've got everything. We're working out more. We're healthier than ever. So it's a really interesting time for us. And my lifestyle is better. I don't have to work a job, right? I told you that already. I can stay home with my son during this whole COVID thing where we have to stay home we have to take care of our kids' education, right? You know, I don't know how working parents are dealing with their kids not being able to go to school. I have no idea how they're handling it. It must be crazy, okay? Now, I've always worked part-time, so I work in the mornings before my son wakes up or when he's at school. So right now I'm working in the mornings basically before he wakes up. Sometimes he's awake and he's right behind me, okay? If you've been watching my lives, you've seen him wake up, come over here, start talking to me. So I work part-time, so I can handle it. I can keep him at home, do his schoolwork with him, go to the beach with him. We went to the beach yesterday. We went surfing on Saturday. I went, running, jogging around Diamond Head yet Sunday. So I live a very nice lifestyle in a beautiful place. I live in Waikiki. The weather is gorgeous. The windows open, sunshine. I go to the beach literally a lot, okay? So I started out knowing nothing with debt and having zero financial knowledge, okay, back during the housing crisis. What I did from then on, some of it was stupid, okay? I'm not going to lie. I made mistakes, but some of it was really smart, like saving money, creating an investment, systematic investment money, investing, learning from my mistakes. Hopefully I'm learning. And I've changed my life. So that's how you can tell. You can tell by looking at a person's lifestyle, their financial situation, has it improved over time, all right? So for many of my friends, it has not. And that's because they're not following the steps, all right? Like I have friends who are not following the steps and now they're working just as hard as they've always been and they're declaring bankruptcy as well. These are the kind of stories I'm hearing now during this crisis, which is probably going to evolve into even more of these kinds of stories. But I'm not part of this, and one of the reasons is I followed the simple steps. So go to the blog, yesfinanciallyfree.com, put your first name and email address on the right side if you haven't done so already, because you get a free ebook, Working Parents Guide to Financial Freedom, as soon as you do that. And you'll know exactly when I go live, where I'm going to be live, and what I'll be talking about. Okay, so yesfinanciallyfree.com. Go ahead, put your first name, email address in there if you haven't already. Get on the email list. And plus, if you ever have a question for me, if you want me to do a live on some certain topic, you can reply to any of my emails and I will respond. I actually do read my emails on a regular basis. So that is a good way to contact me. Okay. All right. So today we are going to read chapter 18, a comparison of 8 pairs of companies. So let's begin. In this chapter, we shall attempt a novel form of exposition. By selecting 8 pairs of companies which appear next to each other, or nearly so, on the stock exchange list, we hope to bring home in a concrete and vivid manner some of the many varieties of character, financial structure, policies, performance, and vicissitudes of corporate enterprises, and of the investment and speculative attitudes found on the financial scene in recent years. In each comparison, we shall comment only on those aspects that have a special meaning and import. Pair 1, Real Estate Investment Trust. Oh, this will be good for me. Stores, offices, factories, etc., and Realty Equities Corp. of New York, Real Estate Investment General Construction. In this first comparison, we depart from the alphabetical order used for the other pairs. It has a special significance for us since it seems to encapsulate, on the one hand, all that has been reasonable, stable, and generally good in the traditional methods of handling other people's money. In contrast, in the other company, with the reckless expansion, the financial legerdemain, and the roller coaster changes so often found in present-day corporate operations. The two enterprises have similar names. For many years, they appeared side by side on the American Stock Exchange list. Their ticker symbols, REI and REC, could easily have been confused, but one of them is a staid New England trust, administered by 3 trustees with operations dating back nearly a century, and with dividends paid continuously since 1889. It has kept throughout to the same type of prudent investments, limiting its expansion to a moderate rate and its debt to an easily manageable figure. The other is a typical New York-based sudden growth venture, which in 8 years blew up its assets from $16.2 million to $154 million, and its debts in the same proportion, which moved out from ordinary real estate operations to a miscellany of ventures, including 2 racetracks, 74 movie theaters, 3 literary agencies, a public relations firm, hotels, supermarkets, and a 26% interest in a large cosmetics firm which went bankrupt in 1970. This conglomeration of business ventures was matched by a corresponding variety of corporate devices, including the following. 1. A preferred stock entitled to $7 annual dividends, but with a par value of only $1, and carried as a liability of $1 per share. 2. A stated common stock value of $2,500,000 at $1 per share, more than offset by a deduction of $5,500,000 as a cost of 209,000 shares of reacquired stock. 3. 3 series of stock option warrants giving rights to buy a total of 1,578,000 shares. 4. At least 6 different kinds of debt obligations in the form of mortgages, debentures, publicly held notes, notes payable to banks, notes, loans, and contracts payable, and loans payable to the Small Business Administration, adding up to over $100 million in March of 1969. In addition, it had the usual taxes and accounts payable. Let us present first a few figures of the 2 enterprises as they appeared in 1960, Table 18-1A. Here we find the trust shares selling in the market for 9 times the aggregate value of equity stock. The trust enterprise had a smaller relative debt and a better ratio of net to gross, but the price of the common was higher in relation to per share earnings. In Table 8.1b, we present the situation about 8 years later. The trust had kept the noiseless tenor of its way, increasing both its revenues and its per share earnings by about 3/4. but realty equities had been metamorphosed into something monstrous and vulnerable. And then he has the tables. This is table 18.1. 18.1. Okay. How did Wall Street react to these diverse developments? By paying as little attention as possible to the trust and a lot to realty equities. In 1968, the latter shot up from 10 to 37 and 3/4, and the listed warrants from 6 to 36.5. On combined sales of 2,432,000 shares. While this was happening, the trust shares advanced sedately from 20 to 30.25 on modest volume. The March 1969 balance sheet of equities was to show an asset value of only $3.41 per share, less than a tenth of its high price that year. The book value of the trust shares was $20.85. The next year, it became clear that all was not well in the equities picture, and the price fell to 9.5. When the report for March 1970 appeared, the stockholders must have felt shell-shocked as they read that the enterprise had sustained a net loss of $13,200,000, or $5.70 per share, virtually wiping out their former slim equity. This disastrous figure included a reserve of $8,800,000 for future losses on investments. Nonetheless, the directors had bravely, declared an extra dividend of 5 cents right after the close of the fiscal year. But no more trouble was in sight. The company's auditors refused to certify the financial statements for 1969 to 1970, and the shares were suspended from trading on the American Stock Exchange. In the over-the-counter market, the bid price dropped below $2 per share. Real estate investment trust shares had typical price fluctuations after 1969. The low in 1970 was 16.5, with a recovery to 26.56 in early 1971. The latest reported earnings were $1.50 per share. The stock was selling moderately above its 1970 book value of $21.60. The issue may have been somewhat overpriced at its record high in 1968, but the stockholders have been honestly and well served by their trustees. Real estate equity story is different and a sorry one. Okay. So then they go on to pair 2. So let's take a look at table 18.1a. Real estate investment trust versus Real Equities Corp. in 1960. So the gross revenues of real estate investment trust were $3,585,000, whereas Real Estate Corp was only $1,484,000. The net income for Real Estate Investment Trust was $485,000, whereas for Real Equities Corp of New York it was $150,000. Earned per share was 0.66 for Real Estate Investment Trust, whereas Realty Equities Corp earned 47 cents per share. Dividends per share were 10 cents for Realty Equities Corp. There were no dividends for Real Estate Investment Trust. Book value per share was $20 for the Real Estate Investment Trust, where it was $4 for Realty Equities Corp. Price range was 20 to 12, and for Real Estate Equities Corp, it was 5 3/8 to 4 3/4. Total assets for Real Estate Investment Trust was $22,700,000. For Realty Equities Corp, $6,200,000. Total liabilities for Real Estate Investment Trust was $7,400,000, and for Realty Equities, $5 million. Book value of common, $15,300,000 for Real Estate Investment Trust, where it's only $1,200,000 for Realty Equities Corp. Average market value of common stock was $12,200,000 for Real Estate Investment Trust, whereas Realty Equities Corp is $1,360,000. And table 18.1b, pair 1. If you want to screenshot it, it's right there. That's the table. Okay. They look at Real Estate Investment Trust and Realty Equities Corp. They look at different things like the price, the number of shares. This is as of 1968. So the first table is 1960, the second table is 1968. And it shows that the price of Real Estate Investment Trust is basically lower than the Corp, 26.5 compared to 32.5. The number of shares is also lower, 1,423,000 to 2,311,000, 2,311,000 for Realty Corp. The market value of the common is also less, 37,800,000 versus Realty Corp of 75 million. And then Realty Corp has all these warrants and other things, which 30 million in warrants. Estimated market of common and warrants is 105 million for the common and the warrants for Realty Corp. The debt, though, is the big difference. For Real Estate Investment Trust, it's only 9,600,000, so everything's lower. But it's markedly lower because Real Estate Equities Corp is 100,800,000, so it's like 10 times higher. The debt is 10 times more. Okay, so everything else is like 2.5 times more, maybe, but the debt is 10 times more. So they're way over leveraged. Preferred stock, 2,900,000. Total capitalization of Real Estate Investment Trust is 47,400,000, whereas the total capitalization Realty Equities Corp is 208,700,000. The market value per share of common, adjusted for warrants, is 45, and that's estimated. The book value per share is 20.85 in November for Real Estate Investment Trust, where it's only $3.41 for Realty Equities Corp. So they already determined that even though the price of the share is 32.5, the actual value they estimate book value per share is only $3.41 for Realty Equities Corp. Whereas for Real Estate Investment Trust is $20.85, which is still lower than the 26.5, but it's a lot closer than 3. It's a very big difference. See, so revenues, and this is they're comparing November 1968 for Real Estate Investment Trust and March 1969 for Realty Equities Corp. They look at the revenues. So the revenues are lower for Real Estate Investment Trust, 6,281,000. The other one is 39,706,000. Net for interest, 2,696,000 for the investment trust, where it's 11,182,000 for Realty Equities Corp. So after you take out interest, basically, Real Estate Investment Trust is paying $4 million a year in interest, whereas Realty Equities Corp is paying $28 million in interest. So that's a lot more interest. Interest charges, $590,000 for Real Estate Investment Trust and $6,684,000 for Realty Equities Corp. Income tax is $58,000 for the trust, whereas it's $2.4 million for the corp. The preferred dividend is $174,000 for the corp. The net for common, $2,048,000 for Real Estate Investment Trust and $1,943,000 for Realty Equities Corp. Special items, $245,000 for Real Estate Investment Trust, whereas the corp had $1,896,000. Final net for common was $2,293,000 for the trust, where it's only $47,000 for the corp. So earned per share before special items, Real Estate Investment Trust earned $1.28 per share, whereas Real Estate Equities Corp earned $1. Earned per share after special items, Real Estate Investment Trust earned $1.43 a share, whereas the corp earned 20 cents. Dividend on common was $1.20 for Real Estate Investment Trust. There was only 30 cents for the corp, and the interest charges earned 4.6 times for Real Estate Investment Trust, where it's 1.8 times for Real Estate Investment Corp. And then they have some footnotes. There were warrants to buy 1.6 million or more shares at various prices. A list issued sold at 30.5 per warrant. As a realty trust, this enterprise was not subjected to federal income tax in 1968. Okay, so that's done with that comparison. They're going to do pair 2, air products and chemicals, industrial and medical gases, and air reduction company, industrial gases and equipment chemicals. So they're similar kinds of companies. They're going to compare these two companies. Even more than our first pair, these two resemble each other in both name and line of business. The comparison they invite is thus of the conventional type in security analysis, while most of our other pairs are more heteroclite in nature. Products is a newer company than Reduction, and in 1969 had less than half the other's volume. Nonetheless, its equity issues sold for 25% more in the aggregate than air reduction stock. As Table 18.2 shows, the reason can be found both in air reduction's greater profitability and in its stronger growth record. We find here the typical consequences of a better showing of quality. Air Products sold at 16.5 times its latest earnings against only 9.1 times for air reduction. Also, Air Products sold well above its asset backing, while air reduction could be bought at only 75% of its book value. Air reduction paid a more liberal dividend, but this may be deemed to reflect a greater desirability for Air Products to retain its earnings. Also, air reduction had a more comfortable working capital position. On that point, we may remark that a profitable company can always put its current position in shape by some form of permanent financing, but by our standards, Air Products was somewhat overbonded. If the analysts were called on to choose between the two companies, he would have no difficulty in concluding that the prospect of Air Products looked more promising than those of air reduction. But did this make Air Products more attractive at its considerably higher relative price? We doubt whether this question can be answered in a definitive fashion. In general, Wall Street sets quality above quantity in its thinking, and probably the majority of security analysts would opt for the better but dearer Air Products as against the poorer but cheaper air reduction. Whether this preference is proved right or wrong is more likely to depend on the unpredictable future than on any demonstrable investment principle. In this instant, air reduction appears to belong to the group of important companies in the low multiplier class. If, as the studies referred to above would seem to indicate, that group as a whole is likely to get a better account of itself than the higher multiplier stocks, then air reduction should logically be given the preference, but only as part of a diversified operation. Also, a thoroughgoing study of the individual companies could lead the analysts to the opposite conclusion, but that would have to be for reasons beyond those already reflected in the past showing. Sequel. Air Products stood up better than air reduction in the 1970 break, with a decline of 16% against 24%. However, reduction made a better comeback in early 1971, rising to 50% above its 1969 close, against 30% for products. In this case, the low multiplier issue scored the advantage for the time being, at least. Okay, so these two companies are very similar. It's just one is showing faster growth and is in a class where people value it more, whereas the other one's showing slower growth. And so it's a better value in that sense, but it's also in a group that doesn't grow fast. So he's saying either way, he really doesn't know which one's better, really. Okay, so Air Products, and he has table 18.2, so you can compare the two companies and how they do. So Air Products and chemicals in 1969 air reduction, okay? So we're going to call them Air Products and air reduction. The price in December 31 of 1969 for products was 39.5, and for air reduction was 16 3/8. So obviously the price was much higher for Air Products and chemicals. The number of shares of common for products was 5,832,000, assuming the conversion of preferred stock. And for air reduction, it was 11,279,000. The market value of the common was 231 million for products and 185 million for reduction. The debt for products was 113 million, and the debt for reduction was 179 million. Total capitalization at market, 334 million for air products and 364 million for air reduction. Book value per share, $22.89 for air products and $21.91 for air reduction. The sales, Air Products sales were 221,500,000, whereas the sales for air reduction were 487,600,000. Wow, that's interesting. Reduction sales were a lot higher. Okay. Net income, 13,639,000 for products and 20,326,000 for reduction. The earned per share as of 1969 was $2.40 for products, $1.80 for reduction. Earned per share in 1964 was identical at $1.51. Earned per share in 1959 for products was 52 cents, and for reduction was $1.95. Current dividend rate is 20 cents per share. Current dividend rate is 20 cents for products and 80 cents for reduction. Dividend has been since 1954 for products and 1917 for reduction. Ratios. Price divided by earnings. So 16.5 is for products, 9.1 is for reduction. Price divided by book value, 165% for products, 75% for reduction. Dividend yield, 0.5% for products, 4.9% for reduction. Net divided by sales, 6.2% for products, 4.25% for reduction. Earnings divided by book value, 11% for Air products and 8.2% for reduction. Current assets divided by liabilities is 1.53 times for Air products, 3.77 times for Air reduction. Working capital divided by debt, 0.32 times for Air products and 0.85 times for Air reduction. Growth in per share earnings from 1969 versus 1964. The growth was 59% for Air products, and for Air reduction it was 19%. From 1969 versus 1959, there was a 362% growth in per share earnings for products, where there was a decrease in Air reduction. So he's saying the two are actually, it's hard to tell which one will do better, basically. Pair number 3, American Home Products Company, drugs, cosmetics, household products, candy, and American Hospital Supply Company, distributor and manufacturer of hospital supplies and equipment. So they're not the same at all, really. But anyway, these were $2 billion goodwill companies at the end of 1969, representing different segments of the rapidly growing and immensely profitable health industry. Oh, okay, I guess you call it health because of the drugs. The other one is totally health. The first one is, anyway. Okay, we shall refer to them as home and hospital respectively. Okay, I guess you could call it that. Selected data on both are presented in Table 18.3. They had the following favorable points in common. Excellent growth with no setback since 1958, i.e. 100% earning stability, and strong financial condition. The growth rate of hospital up to the end of 1969 was considerably higher than home's. On the other hand, home enjoyed substantially better profitability on both sales and capital. In fact, the relatively low rate of hospital earnings on its capital in 1969, only 9.7%, raises the intriguing question whether the business then was, in fact, a highly profitable one despite its remarkable past growth rate in sales and earnings. When comparative price is taken into account, home offered much more for the money in terms of current or past earnings and dividends. The very low book value of home illustrates a basic ambiguity or contradiction in common stock analysis. On the one hand, it means that the company is earning a high return on its capital, which in general is a sign of strength and prosperity. On the other hand, it means that the investor at the current price would be especially vulnerable to any important adverse change in the company's earnings situation. Since hospital was selling at over 4 times its book value in 1969, this cautionary remark must be applied to both companies. Conclusions. Our clear-cut view would be that both companies were too rich at their current prices to be considered by the investor who decides to follow our ideas of conservative selection. This does not mean that the companies were lacking in promise. The trouble is rather that their price contained too much promise and not enough actual performance. For the two enterprises combined, the 1969 price reflected almost $5 billion of goodwill valuation. How many years of excellent future earnings would it take to realize that goodwill factor in the form of dividends or tangible assets? Short-term sequel. At the end of 1969, the market evidently thought more highly of the earnings prospects of hospital than of home, since it gave the former almost twice the multiplier of the latter. As it happened, the favored issue showed a microscopic decline in earnings in 1970, while home turned in a respectable 8% gain. The market price of hospital reacted significantly to this one-year disappointment. It sold at 32 in February 1971, a loss of 30% from its 1969 close, while home was quoted slightly above its corresponding level. Okay, so these are a pair of companies that are both overpriced. He feels like they're both overpriced. Table 18.3, pair 3, giving different examples in the market so you can see how they would analyze them. Okay, so we have American Home Products and American Hospital Supply in 1969. The price of products versus supply, okay? Products is $72 a share, whereas hospital supply is 45 1/8. Okay, excuse me. Okay, number of shares of common is 52,300,000 for American Home Products and 33,600,000 for American Hospital Supply. Market value of common is 3,800,000,000, and the market value of hospital is 1,515,000,000. Debt is 11 million for products and 18 million for hospital. Total capitalization at market is 3,811,000 for products and 1,534,000 for supply. Book value per share is $5.73 for American Home Products, $7.84 for supply. Sales are 1,193,000,000 for products, 446 million for supply. Net income is 123,300,000 for products and 25 million for supply. Earned per share in 1969 is $2.32 for products and 77 cents for supply. Earned per share in 1964 was $1.37 for products and 31 cents for supply. Earned per share in 1959 was 92 cents for products and 15 cents for supply. Current dividend rate is $1.40 and for products and 24 cents for supply. Dividends since 1919 for products and 1947 for supply. Ratios, price divided by earnings. We take the price divided by earnings as 31 times for products and 58 times for supply. Price divided by book value is 1,250% for products, where it's 575% for supply. Dividend yield is 1.9% for products, 0.55% for supply. Net divided by sales is 10.7% for products and 5.6% for American Hospital Supply. Earnings divided by book value, 41% for products and 9.5% for American Hospital Supply. And current assets divided by liabilities is 2.6 for products and 4.5 for American Hospital Supply. Growth in per share earnings, 1969 versus 1964 is 75% for products, 142% for supply. 1969 versus 1959, 161% for products, 405% for hospital supply. Okay, so that's all the statistics they give there. Let me just go back. We shall refer to them as home and hospital respectively. Selected data both are in table 18.3, which I just went over. They had the following favorable points in common: excellent growth, no setbacks since 1958, 100% earning stability. They had strong financial condition. The growth rate of hospital up to the end of 1969 was considerably higher than homes. Yes. On the other hand, home enjoyed substantially better profitability on both sales and capital. In fact, the relatively low rate of hospital's earnings on its capital, only 9.7%, raises the intriguing question whether the business then was in fact a highly profitable one, despite its remarkable past growth rate in sales and earnings. Okay, let's look at pair 4. I might have to go back and study these. Okay, so I was going to show you a table, but let's just read. H&R Block. Oh, H&R Block. Income Tax Service and Bluebell Inc., manufacturers of work clothes uniforms. These companies rub shoulders as relative newcomers to the New York Stock Exchange, where they represent two very different genres of success stories. Bluebell came up the hard way in a highly competitive industry in which eventually it became the largest factor. Its earnings have fluctuated somewhat with industry conditions, but their growth since 1965 has been impressive. The company's operations go back to 1916 and its continuous dividend record to 1923. At the end of 1969, the stock market showed no enthusiasm for the issue, giving it a price divided by earnings ratio of only 11 against about 17 for the S&P Composite Index. By contrast, the rise of H&R Block has been meteoric. Its first published figures date only to 1961, in which year it earned $83,000 on revenues of $610,000. But 8 years later, on our comparison date, its revenues had soared to $53.6 million and its net to $6.3 million. At that time, the stock market's attitude toward this fine performer appeared nothing less than ecstatic. The price of $55 at the close of 1969 was more than 100 times the last reported 12-month earnings, which of course were the largest to date. The aggregate market value of $300 million for the stock issue was nearly 30 times the tangible assets behind the shares. This was almost unheard of in all the annals of serious stock market valuations. At that time, IBM was selling at about 9 times and Xerox at 11 times book value. Our table 18.4 sets forth in dollar figures and in ratios the extraordinary discrepancy in the comparable valuations of Block and Bluebell. True, Block showed twice the profitability of Bluebell per dollar of capital, and its percentage growth in earnings over the past 5 years from practically nothing was much higher. But as a stock enterprise, Bluebell was selling for less than 1/3 the total value of Block. Although Bluebell was doing 4 times as much business, earning 2.5 times as much for its stock, had 5.5 times as much in tangible investment, and gave 9 times the dividend yield on the price. Indicated conclusions. An experienced analyst would have conceded great momentum to Block, implying excellent prospects for future growth. He might have some qualms about the dangers of serious competition in the income tax service field, lured by the handsome return on capital realized by Block. The reader will recall from page 242 above that AAA Enterprises tried to enter this business but quickly failed. But mindful of the continued success of such outstanding companies as Avon Products in highly competitive areas, he would have hesitated to predict a speedy flattening out of the Block growth curve. His chief concern would be simply whether the $300 million valuation for the company had not already fully valued and perhaps overvalued all that one could reasonably expect from this excellent business. By contrast, the analyst should have had little difficulty in recommending Bluebell as a fine company, quite conservatively priced. Sequel to March 1971. The 1970 near panic lopped 1/4 off the price of Bluebell, and about 1/3 from that of Block. Both then joined in the extraordinary recovery of the general market. The price of Block rose to 75 in February 1971, but Bluebell advanced considerably more, to the equivalent of 109, after a 3-for-2 split. Clearly, Bluebell proved a better buy than Block as of the end of 1969, but the fact that Block was able to advance some 35% from that apparently inflated value indicates how wary analysts and investors must be to sell good companies short, either by word or deed, no matter how high the quotation may seem. Okay, so let's take a look at the table. Table 18.4. So this one is of 2 companies, right? Both are profitable. One is a new kind of company in a new field, tax preparation. It's doing very well. Grow from nothing. So it's doing quite well, but its stock price is ginormous compared to what its earnings are. However, it does okay, is what he's saying. So even though it's highly inflated, it's hard to say whether it's too inflated. And Bluebell, which was a good deal, is a good deal. So there you have it there. So he has some figures here. H&R Block in 1969 and Bluebell in 1969. The price of H&R Block was 55, whereas Bluebell was 49 3/4. The number of shares of common were 5,426,000 for Block, 1,802,000 for Bluebell, assuming conversion of preferred stock. So Bluebell had a lot less stock outstanding. The prices were similar. Market value of common, $298 million for Block and $89,500,000 for Bluebell. Debt. H&R Block had no debt. Bluebell has $17,500,000 in debt. Total capitalization at market is $298 million for Block and $107 million for Bluebell. Book value per share, $1.89 for H&R Block, $34.54 for Bluebell. Well, that's a huge difference, yeah? Sales, $53,600,000 for H&R Block, $202,700,000 for Bluebell. Net income for Block is $6,380,000, where it's $7,920,000 for Bluebell. Earns per share in 1969 was 51 cents for Block in October, $4.47 for Bluebell. Earned per share in 1964, 7 cents for Block, $2.64 for Bluebell. Earned per share in 1959 was 0 for Block, $1.80 for Bluebell. Current dividend rate is 24 cents for Block, $1.80 for Bluebell. Dividend since 1962 for Block, 1923 for Bluebell. Price divided by earnings, 108 times for Block, 11.2 times for Bluebell. Price divided by book value, 2,920% for Block, 140% for Bluebell. Dividend yield is 0.4% for Block, 3.6% for Bluebell. Net divided by sales is 11.9% for Block, 3.9% for Bluebell. Earnings divided by book value is 27% for Block, whereas it's 12.8% for Bluebell. Current assets divided by liabilities are 3.2 times for Block, 2.4 times for Bluebell. Working capital divided by debt. There is no debt for Block. There's 3.75 for Bluebell. The growth in share and per share earnings from 1969 versus 1964 is 630% for Block, whereas it's 68% for Bluebell. 1969 versus 1959, there is no information for Block, but it's 148% for Bluebell. Okay. The next pair. Pair 5. International flavors and fragrances, flavors, etc. for other businesses, and International Harvester Company, truck manufacturer, farm machinery, construction machinery. This comparison should carry more than one surprise. Everyone knows of International Harvester, one of the 30 giants in the Dow Jones Industrial Average. How many of our readers have even heard of International Flavors and Fragrances? Next door neighbor to Harvester on the New York Stock Exchange list, yet Mirabile Dictu, whatever that means, IFF, the International Flavors and Fragrances, was actually selling at the end of 1969 for a higher aggregate market value than Harvester, $747 million versus $710 million. This is the more amazing when one reflects that Harvester had 17 times the stock capital of Flavors, 27 times the annual sales. In fact, only 3 years before, the net earnings of Harvester had been larger than the 1969 sales of Flavors. How did these extraordinary disparities develop? The answer lies in the two magic words, profitability and growth. Flavors made a remarkable showing in both categories, while Harvester left everything to be desired. The story is told in Table 18.5. Here we find Flavors with a sensational profit of 14.3% of sales. Before income tax, the figure was 23%, compared with the mere 2.6% for Harvester. Similarly, Flavors had earned 19.7% on its stock capital against an inadequate 5.5% earned by Harvester. In 5 years, the net earnings of Flavors had nearly doubled, while those of Harvester practically stood still. Between 1969 and 1959, the comparison makes similar reading. These differences in performance produced a typical stock market divergence in valuation. Flavors sold in 1969 at 55 times its last reported earnings, and Harvester at only 10.7 times. Correspondingly, Flavors was valued at 10.4 times its book value, while Harvester was selling at 40% discount from its net worth. Comment and conclusions. The first thing to remark is that the market success of Flavors was based entirely on the development of its central business and involved none of the corporate wheeling and dealing, acquisition programs, top-heavy capitalization structures, and other Wall Street practices of recent years. The company has stuck to its extremely profitable knitting, and that is virtually its whole story. The record of Harvester raises an entirely different set of questions, but these two have nothing to do with high finance. Why have so many great companies become relatively unprofitable even during many years of general prosperity? What is the advantage of doing more than $2.5 billion of business if the enterprise cannot earn enough to justify the stockholders' investment? It is not for us to prescribe the solution of this problem. But we insist that not only management but the rank and file stockholders should be conscious that the problem exists and that it calls for the best brains and best efforts possible to deal with it. From the standpoint of common stock selection, neither issue would have met our standards of sound, reasonable, attractive, and moderately priced investment. Flavors was a typical, brilliantly successful but lavishly valued company. Harvester's showing was too mediocre to make it really attractive even at its discount price. Undoubtedly, there were better values available in the reasonably priced class. Sequel to 1971. The low price of Harvester at the end of 1969 protected it from a further decline in the bad break of 1970. It lost only 10% more. Flavors proved more vulnerable and declined to 45, a loss of 30%. In the subsequent recovery, both advanced well above their 1969 close, but Harvester soon fell back to the 25 level. Okay, so this is a table for Harvester and Flavors. You can see that on YouTube, and then on Instagram, it's right there. Okay, so International Flavors and Fragrances, 1969. Price as of December 31st, 1969 was $65.50 for Flavors, and for Harvester it was $24 3/4. The number of shares outstanding was 11,400,000 for Flavors, 27,329,000 for Harvester. The market value of common was $747 million for Flavors, and $710 million for Harvester. The debt for Flavors is $4 million. The debt for Harvester is $313 million. Total capitalization at market is $751 million for Flavors, $1,023 million for Harvester. Book value per share for Flavors is $6.29, where it's $41.70 for Harvester. Sales are $94,200,000 for Fragrances, but $2,652,000 for Harvester. However, net income is $13,540,000 for Flavors and $63,800,000 for Harvester. So earned per share in 1969 was $1.19 for Flavors and $2.30 for Harvester. Earned per share in 1964, 62 cents for Flavors, $3.39 for Harvester. Earned per share in 1959, 28 cents for Flavors, $2.83 for Harvester. Current dividend rate is 50 cents for Flavors, $1.80 for Harvester. Dividends since 1956 for Flavors and 1910 for Harvester. The ratios: price divided by earnings, 55 for Flavors, 10.7 for Harvester. Price divided by book value is 1,050% for Flavors and 59% for Harvester. Dividend yield is 0.9% for Flavors, 7.3% for Harvester. Net divided by sales is 14.3% for Flavors, 2.6% for Harvester. Earnings divided by book value, 19.7% for Flavors, 5.5% for Harvester. Current assets divided by liabilities are 3.7 for Flavors and 2 for Harvester. Excuse me. Excuse me. Working capital divided by debt is large for Flavors and 1.7 times for Harvester. Interest earned is 0 for Flavors and before tax 3.9 for Harvester. Growth in per share earnings is 93% from 1969 to 1964 for Flavors. In the same period, it was 9% for Harvester. 1969 versus 1959, it was 326% for Flavors and only 39% for Harvester. Okay, so these two companies they would not recommend. One is not very good with being big, and the other one is growing too fast. Pair 6. Not growing too fast, but it's overvalued for the growth. It's growing well, but it's overvalued is what they're saying. Pair number 6, McGraw-Edison, Public Utility and Equipment, Housewares. McGraw-Hill, Inc., Books, Films, Instruction Systems, Magazines, Newspaper Publishers, Information Systems. This pair with so similar names, which at times we shall call Edison and Hill, yeah, McGraw-Edison and McGraw-Hill, how interesting, are two large and successful enterprises in vastly different fields. Yeah. We have chosen December 1931, 1968 as the date of our comparison. Developed in Table 18.6, the issues were selling at about the same price, but because of Hill's larger, Hill is the one with books. Edison is the one that's a utility company. Okay. I could remember that. Thomas Edison, utilities. I can remember that. I don't know if that's anything to do with the company, but But Hill's larger capitalization, because of Hill's larger capitalization, it was valued at about twice the total figure of the other. This difference should appear somewhat surprising since Edison had about 50% higher sales and 1/4 larger net earnings. As a result, we find that the key ratio, the multiplier of earnings, was more than twice as great for Hill as for Edison. This phenomena seems explicable chiefly by the persistence of strong enthusiasm and partiality exhibited by the market towards shares of book publishing companies, several of which had been introduced to the public trading in the late 1960s. Actually, by the end of 1968, it was evident that this enthusiasm had been overdone. The Hill shares had sold at 56 in 1967, more than 40 times the just reported record earnings for 1966. But a small decline had appeared in 1967 and a further decline in 1968. Thus, the current multiplier of 35 was being applied to a company that had already shown 2 years of receding profits. Nonetheless, the stock was still valued at more than 8 times its tangible asset backing, indicating a goodwill component of not far from $1 billion. Thus, the price seemed to illustrate, in Dr. Johnson's famous phrase, the triumph of hope over experience. By contrast, McGraw-Edison seemed quoted at a reasonable price in relation to the high general market level and to the company's overall performance and financial position. Sequel to early 1931. The decline of McGraw-Hill's earnings continued through 1969 and 1970, dropping to $1.02, then to 82 cents per share. In the May 1970 debacle, its price suffered a devastating break to 10, less than a fifth of the figure 2 years before. It had a good recovery thereafter, but the high of 24 in May 1971 is still only 60% of the 1968 closing price. McGraw-Edison gave a better account of itself, declining to 22 in 1970 and recovering fully to 41.5 in May 1971. McGraw-Hill continues to be a strong and prosperous company, but its price history exemplifies, as do so many other cases, the speculative hazards in such stocks created by Wall Street through its undisciplined waves of optimism and pessimism. Okay, so Hill continues to be a strong, prosperous company, but its price history is not great because it went up too high fast and then it went down, so people lost a lot of money if they bought the stock. Although the company is doing fine, the stock is not doing well. Okay, so that's 18.6, pair 6. That's the table for YouTube if you want to screenshot it. And here's the table for Instagram. Okay, so let's take a look. McGraw-Edison, 1968, McGraw-Hill, 1968. And remember, Edison is the utility company. And I remember that because of Thomas Edison, so that makes it easier. Hill is the publishing company. Okay, so the price in 1968 was the same, pretty much. 37 5/8 for Edison, 39 3/4 for Hill. The number of shares of common were 13,717,000 for Edison, 24,200,000 for McGraw-Hill. Market value of common was 527 million for Edison, 962 million for Hill, 6,000 debt for Edison, and $6 million of debt for Edison and $53 million for Hill. Wow. Total capitalization at market was 533 million for Edison and 1,015 million for Hill. Book value per share is $20.53 for Edison, $5 for Hill. Instagram is going to end the live soon, so I just want to mention that. If you want to see more of this book or other great things, I'm reading a very kind of dry book, but if you want to see more entertaining blogs, this is unusual for me to read a book, but during COVID, I decided to read a book to educate myself and everyone else watching. Go to yesfinanciallyfree.com, put your first name, email address. If you haven't done so already, get on the email list. Check out the blog. There's lots of blog posts there. Most of them are more entertaining, but I don't know if they're as educational. I think they're a lot of them are very good for you, very good for me, and you should check them out. So just saying that because Instagram's going to end soon. Follow me, share this with your friends and followers. Check out the blog for the replay, the full replay. Okay, so the book value per share is much more for Edison. It's $20.53 in 1968, whereas it's only $5 for McGraw-Hill. The sales of Edison is 568,600,000 whereas for Hill, it's 398,300,000. The net income for Edison is 33,400,000. Net income for Hill is 26,200,000. Earned per share in 1968 is $2.44, whereas Hill is $1.13. Earned per share in 1963 is $1.20 for Edison, 66 cents for Hill. $1.02 in 1958 for Edison, 46 cents for Hill. Current dividend rate is $1.40 for Edison, 70 cents for Hill. Dividends since 1934 for Edison, 1937 for Hill. And the price divided by earnings is 15.5 times for Edison, where it's 35 times for McGraw-Hill. Price divided by book value is 183% for Edison, 795% for McGraw-Hill. Dividend yield is 3.7% for Edison, 1.8% for McGraw-Hill. Net divided by sales is 5.8% for Edison, 6.6% for Hill. Earnings divided by book value is 11.8% for Edison, 22.6% for Hill. Current assets divided by liabilities are 3.95 for Edison, 1.75 for Hill. Working capital divided by debt is large for Edison, 1.75 for Hill. Growth in per share earnings from 1963 to 1968 is 104% for Edison, where it's 71% for Hill. Between 1958 to 1968, it's 139% for Edison and it's 146% for Hill. Okay. Pair number 7, National General Corp, a large conglomerate, and National Presto Industries, diverse electric appliances ordinance. These two companies invite comparison chiefly because they are so different. Okay. Let us call them General and Presto. We have selected the end of 1968 for our study because the write-offs taken by General in 1969 made the figures for that year too ambiguous. The full flavor of General's far-flung activities could not be savored the year before, but it was already a conglomerate enough for anyone's taste. The condensed description in the stock guide read, and this is for General, National General Corp. Okay. Nationwide theater chain, motion picture and TV production, savings and loan association, and book publishing, to which could be added then or later insurance, investment banking, records, music publishing, computerized systems, real estate, and 35% of Performance Systems, Inc. Name recently changed from Mini Pearls Chicken System, Inc. Okay. Presto had also followed a diversification program, but in comparison with General, it was modest indeed. Starting as the leader maker of pressure cookers, it had branched out into various other household electric appliances. Quite differently also, it took on a number of ordnance contracts for the U.S. government. Our Table 8.7 summarizes showing of the companies at the end of 1968. The capital structure of Presto was as simple as it could be. Nothing but 1,478,000 shares of common stock selling in the market for $58 million. Contrastingly, General had more than twice as many shares of common, plus an issue of convertible preferred, plus 3 issues of stock warrants calling for a huge amount of common, plus a towering convertible bond issue, just given in exchange for stock of an insurance company, plus a goodly sum of non-convertible bonds. All this added up to a market capitalization of $534 million. Not counting an impending issue of convertible bonds and $750 million including such issue. Despite National General's enormously greater capitalization, it had actually done considerably less gross business than Presto in their fiscal years, and it had shown only 75% of Presto's net income. The determination of true market value of General's common stock capitalization presents an interesting problem for security analysts and has important implications for anyone interested in the stock on any basis more serious than outright gambling. The relatively small $4.50 convertible preferred can be readily taken care of by assuming its conversion into common when the latter sells at a suitable market level. This we have done in Table 18.7, but the warrants require different treatment. In calculating the full dilution basis, the company assumes exercise of all the warrants and the application of the proceeds to the retirement of debt, plus use of the balance to buy in common at the market. These assumptions actually produced virtually no effect on the earnings per share in calendar 1968, which were reported as $1.51 both before and after the allowance for dilution. We consider this treatment illogical and unrealistic. As we see it, hold on a second, my husband is calling. Hey, I'm on a live and I have 4 more pages. So, I mean, he can come and wait for me, I guess. I'm still reading. Another 20 minutes. Bye. Okay. Let's move on. I told him I'd be busy today, but that's okay. Okay. This is a long chapter, though. That's why. I have to figure out where I was. Okay. Let's go back. These assumptions actually produce virtually no effect on the earnings per share in calendar 1968, which reported as $1.51 both before and after the allowance for dilution. We consider this treatment illogical and unrealistic. As we see it, the warrants represent a part of the common stock package, and their market value is part of the effective market value of the common stock, part of the capital. See our discussion on this point on page 230 above. This simple technique of adding the market price of the warrants to that of the common has a radical effect on the showing of National General at the end of 1968. It appears from the calculation in table 18.7. In fact, the true market price of the common turns out to be more than twice the quoted figure. Hence, the true multiplier of 1968 earnings is more than doubled to the inherently absurd figure of 69 times. The total market value of the common stock equivalents then becomes 413 million, which is over 3 times the tangible assets shown therefore. These figures appear the more anomalous when comparison is made with those of Presto. One is moved to ask how Presto possibly could valid only at 6.9% its current earnings, when the multiplier by General was nearly 10 times as great. All the ratios of Presto are quite satisfactory. The growth figure suspiciously so, in fact. By that we mean that the company was undoubtedly benefiting considerably from its war work, and the stockholders should be prepared for some falling off of profits under peacetime conditions. But, on balance, Presto met all the requirements of a sound and reasonably priced investment, while General had all the earmarks of a typical conglomerate, the late 1960s vintage, full of corporate gadgets, grandiose gestures, but lacking in substantial values behind the market quotations. Sequel. National continued its diversification policy in 1969 with some increase in its debt. National. That means General. They changed their the way they talk about it from General to National. But anyway, National General continued its diversification policy in 1969 with some increase in its debt. But it took a whopping write-off of millions, chiefly in the value of its investment in the Mini Pearl chicken deal. The final figures showed a loss of $72 million before tax credit and $46.4 million after tax credit. The price of the shares fell to 16.5 in 1969 and as low as 9 in 1970, only 15% of the 1968 high of 60. Earnings for 1970 were reported at $2.33 per share diluted, and the price recovered to 20.5 in 1971. National Presto increased its per share earnings somewhat in both 1969 and 1970, marking 10 years of uninterrupted growth in profits. Nevertheless, its price declined to 21.5 in the 1970 debacle. This was an interesting figure, since it was less than 4 times the last reported earnings and less than the net current assets available for the stock at the time. Late in 1971, we find the price of National Presto 60% higher at 34. But the ratios are still startling. The enlarged working capital is still about equal to the current price, which in turn is only 5.5 times the last reported earnings. The investor could now find 10 such issues for diversification. He can be confident of satisfactory results. Okay. Pair 7, 18.7. Okay, let's take a look. So the price of National General in 1968 was 44.25, whereas National Presto Industries was 38.58. The number of shares of common were 4,330,000, and that's assuming conversion of preferred stocks for National General. For Presto, it was 1,478,000. So the market value of common was 192 million for General and 58 million for Presto. Add the market value of 3 issues of warrants is $221 million. So the total value of common and warrants is $432 million. Senior issues is $120 million. So the total capitalization at market is $534 million, whereas for National Presto, it's $58 million. Market price of common stock adjusted for warrants. For National General, it's negative $98, whereas for National Presto, they don't have a figure because they don't have warrants. Book value of common is $31.50 for General, $26.30 for Presto. Sales and revenues for General is $117,600,000, whereas for Presto it's $152,200,000. Net income, net income is $6,121,000 for General and $8,206,000 for Presto. Earned per share in 1968 was $1.42 for National General and $5.61 for Presto. Earned per share in 1963 was 96 cents for General and $1.03 for Presto. In 1958, 48 cents for General, 77 cents for Presto. Current dividend is 20 cents for General, 80 cents for Presto. Dividend since 1964 for General, 1945 for Presto. Price divided by earnings, 69 for General, 6.9 for Presto. Price divided by book value is 310% for General, 142% for Presto. Dividend yield is 0.5% for General, 2.4% for Presto. Net divided by sales is 5.5% Presto, 5.4 General, 5.4 Presto. Earnings divided by book value is 4.5% for General, 21.4% for Presto. Working capital divided by debt is 0.21 for General. There is no debt for Presto. Growth in earnings per share, 48% from 1963 to 1968 for General, 450% for Presto. From 1960 to 1968, it's 195% for General, 630% for Presto. They're saying you should invest in companies like Presto. Okay, and not in companies like General. Pair 8, Whiting Corporation, Materials Handling Equipment, and Wilcox and Gibbs Small Conglomerate. These pair are close, but not touching neighbors on the American Stock Exchange list. The comparison set forth in Table 18.8a makes one wonder if Wall Street is a rational institution. The company, with smaller sales and earnings, with half the tangible assets for the common, sold at about 4 times the aggregate value of the other. The higher valued company was about to report a large loss after special charges. It had not paid a dividend in 13 years. The other had a long record of satisfactory earnings and had paid continuous dividends since 1936. It was currently returning one of the highest dividend yields in the entire common stock list. To indicate more vividly the disparity in the performance of the two companies, we append in Table 18.8b the earnings and price record for 1961 to 1970. The history of the two companies throws an interesting light on the development of medium-sized businesses in this country, in contrast with much larger-sized companies that have mainly appeared in these pages. Whiting was incorporated in 1896 and thus goes back at least 75 years. It seems to have kept pretty faithfully to its materials handling business. It has done quite well with it over the decades. Wilcox and Gibbs goes back even farther, to 1866. It was long known to its industry as a prominent maker of industrial sewing machines. During the past decade, it adopted a policy of diversification in what seems a rather outlandish form. For on the one hand, it has an extraordinarily large number of subsidiary companies, at least 24, making an astonishing variety of products, but on the other hand, the entire conglomeration adds up to a mighty small potatoes by usual Wall Street standards. The earnings developments in Whiting are rather characteristics of our business concerns. The figures show steady and rather spectacular growth from 41 cents a share in 1960 to $3.63 in 1968, but they carry no assurance that such growth must continue indefinitely. Subsequent decline to only $1.77 for the 12 months ending in 1971 may have reflected nothing more than the slowing down of the general economy, but the stock price reacted in severe fashion, falling about 60% from its 1968 high of 43.5 to close of 1969. Our analysis would indicate that the shares represented a sound and attractive secondary issue investment suitable for the enterprising investor as part of a group of such commitments. Sequel. Wilcox and Gibbs showed a small operating loss for 1970. Its price declined drastically to a low of 4.5, recovering in typical fashion to 9.5 in February of 1971. It would be hard to justify that price statistically. Whiting had a relatively small decline to 16 and 3/4 in 1970. At that price, it was selling at just about the current assets alone available for the shares. Its earnings held at $1.85 per share to July 1971. In early 1971, the price advanced to 24.5, which seemed reasonable enough, but no longer a bargain by our standards. Okay. So, I'm not sure why he showed the company has smaller sales potential. Higher value company was about to report a large loss. Okay, the other had a long record of satisfactory earnings, continued to pay dividends, currently returning highest dividend yields. And then there's to indicate more vividly the disparity, we append in table 18.8b the earnings and price record. History too throws an interest in the development of medium-sized business in this country. Contrast with much larger-sized companies that have mainly appeared in these pages. Whiting. Okay, so these are medium-sized businesses. Okay, so he's just showing a pair of medium-sized businesses as an example. So that's the table 18.8, and this is the other table here, the first table. Okay. Okay. Take a look at the tables. Whiting and Wilcox and Gibbs. All right. Materials handling and a small conglomerate. All right. So Whiting, basically in 18.8b, Whiting and Wilcox and Gibbs, the price ranges, he's trying to say the price ranges have something going on here. So let's take a look. In 1961, the price ranges are 12.5 for Whiting to 7 3/4. For Wilcox and Gibbs, it's 19.5 to 10.5. Okay, so they have kind of the same. Well, Whiting has a smaller range of price than Wilcox and Gibbs. And then the price range in 1962 is 10 to 6.5 for Whiting, and 19 3/4 to 8 1/4 for Wilcox and Gibbs. It's 15 to 9 for Whiting in 1963, and it's 14 to 4 3/4 for Wilcox and Gibbs. So Wilcox and Gibbs is having a much larger price decrease than Whiting. Okay, Whiting is 14 to 8 to 1964, whereas Wilcox and Gibbs is 9.5 to 4.5. So that's much lower. 1965, Wilcox and Gibbs is 20 to 18, whereas Gibbs is 10 3/8 to 6 1/8. Still very low for Gibbs. 1966, we have 30 1/4 to 19 1/4 for Whiting, whereas 8 to 3 1/4 for Gibbs, very low for Gibbs. 1967 is 36.5 to 25 for Whiting, 11 to 4 3/4 for Gibbs. 43 1/8 in 1968 to 28 1/4 for Whiting, 20 1/8 to 8 1/3 for Gibbs. Jeez. 1969, we have 37 to 17 3/4 for Whiting, whereas we have 20 5/8 to 8 3/4 for Gibbs. And in 1970 is 22.5 to 16 1/4 for Whiting, whereas 18.5 to 4.5 for Gibbs. So the price drop for Gibbs and the price decline for Gibbs seems to be lower. Whereas Whiting showed growth over time, Gibbs did not show growth. It actually showed decline over time. Okay, so these are medium-sized companies. So I guess you want to compare to medium-sized companies. I'm not going to go into the table. I promised my husband I'd be ready by 10. So let's go on. General observations. The issues used in these comparisons were selected with some malice of forethought, and thus they cannot be said to present a random cross-section of the common stock list. Also, they are limited to the industrial section, and the important areas of public utilities, transportation companies, and financial enterprises do not appear. But they vary sufficiently in size, lines of business, and qualitative and quantitative aspects to convey a fair idea of the choices confronting an investor in common stocks. The relationship between price and indicated values also differed greatly from one case to another. For the most part, the companies with better growth records and higher profitability have sold at higher multipliers of current earnings, which is logical enough in general. Whether the specific differentials in price divided by earnings ratios are justified by the facts or will be vindicated by further future developments cannot be answered with confidence. On the other hand, we do have quite a few instances here in which a worthwhile judgment can be reached. These include virtually all the cases where there was a great market activity in companies of questionable underlying soundness. Such stocks were speculative, which means inherently risky, but a good deal of the time they were and are obviously overvalued. Other issues appear to be worth more than their price, being affected by the opposite sort of market attitude, which we might call under speculation, or by undue pessimism because of a shrinkage in earnings. In Table 8.9, we provide some data on the price fluctuations of issues covered in this chapter. Most of them had large declines between 1961 and 1962, as well as from 1969 to 1970. Most of them had large declines in 1961, 1962, as well as, clearly, the investor must be prepared for this type of adverse market movement in future stock markets. In Table 18.10, we show year-to-year fluctuations of McGraw-Hill common stock for the period of 1958 to 1970. It will be noted that in each of the last 13 years, the price either advanced or declined over a range of at least 3 to 2 for 1 year to the next. In the case of National General, fluctuations of at least amplitude, both upward and downward, were shown in each 2-year period. In studying the stock list for the material in this chapter, we were impressed once again by the wide difference between the usual objectives of security analysis and those we deem dependable and rewarding. Most security analysts try to select the issues that will give the best account of themselves in the future in terms generally of market action, but considering also the development of earnings. We are frankly skeptical as to whether this can be done with satisfactory results. Our preference for the analyst's work would be rather that he should seek the exceptional or minority cases in which he can form a reasonably confident judgment that the price is well below value. He should be able to do this work with sufficient expertness to produce satisfactory average results over the years. Okay, I'm going to end it now. Thank you so much for being on the live. I will show you the tables, though I won't talk about them. So you can screenshot them and look at them yourself. That was Table 18.9, some price fluctuations of 16 common stocks. And this is Table 18.10, large year-to-year fluctuations of McGraw-Hill, showing the fluctuations from year to year of that stock price and how that goes. Okay, so thanks for being on the live today. I will do chapter 19 tomorrow. And we're almost done with this book. Okay, thank you for being on the live. Check out the blog, yesfinanciallyfree.com. My name is May Dildow. Aloha.